BigBear.ai Holdings Inc., trading under the ticker symbol BBAI on the New York Stock Exchange, is currently priced at $4.04 per share, marking a modest intraday increase of 0.50% as of midday trading on Friday, June 12, 2026. While the broader indices are flashing mild green today, the baseline equity value of BigBear.ai hides an incredibly complicated tug-of-war between speculative optimism and cold contract performance that standard retail investors are completely overlooking right now. Most traders look at small-cap artificial intelligence plays and assume their valuations are tied entirely to software licensing models or tech sector hype cycles, hoping for a sudden vertical pop based on a viral product release. The reality, however, is that BigBear.ai operates much more like a traditional defense contractor mixed with a heavy infrastructure logistics firm, meaning its true valuation driver is not viral customer acquisition, but rather back-end order backlogs and federal compliance clearances. Just yesterday, the company made a massive operational push by finalizing a foundational deployment agreement with the Panama Transshipment Group to embed its security management software directly across the Dry Canal logistics network. This specific development catches the market off guard because retail investors are hyper-focused on public sector defense contracts, completely missing how the company is quietly trying to anchor itself inside multi-billion-dollar international trade choke points. When you look at how people talk about BigBear.ai on popular self-investing forums or check its positioning across modern investing sites, the general narrative is that it is a high-risk, high-reward penny stock riding the coattails of major enterprise tech giants. People open their individual brokerage accounts or scroll through the Robinhood app seeing a ticker under $5, and they immediately buy in with the expectation that any small federal contract announcement will double the price overnight. This common expectation creates a fragile retail baseline that is highly sensitive to short-term trading volumes, but fundamentally detached from how institutional wealth treats the asset. Serious funds tracking this asset class do not view it through the lens of casual online investing platforms. They treat it as an industrial analytics integration play. The massive tension here lies between the retail crowd expecting lightning-fast software as a service scale and the reality of long-duration, high-consequence deployment cycles that require massive upfront capital expenditures and human labor. If you expect a software company with 90% gross margins, the financial sheets of this specific business model will constantly disappoint you. Yet if you understand it as a hybrid defense and logistics systems integrator, the structural foundation looks entirely different. Looking closely at recent trading volumes and institutional movements over the past several quarters reveals a distinct pattern of consolidation that is frustrating short-term momentum traders. Institutional investors who manage portfolios through platforms like Schwab Intelligent Portfolios or Advanced Interactive Brokers trading setups are not buying this stock for wild daily swings. They are looking at the company's ability to secure sticky, multi-year revenue streams, such as the $60 million in new national security contracts reported during their first quarter earnings update in May. The volume profile shows that every time retail traders panic sell during broader macroeconomic pullbacks, larger entities accumulate shares in block trades, creating an artificial floor around the $3 mark. This institutional activity suggests that the smart capital is ignoring the short-term noise of daily equity fluctuations and looking directly at contract backlog growth as the primary indicator of survival and eventual profitability. While a casual trader using a Robinhood stock trading account might see a sudden 7% drop over a 3-day window in panic, a professional using interactive brokers platform tools is looking at the rolling average of government task orders to determine if the long-term thesis remains intact. The sector momentum surrounding artificial intelligence has shifted dramatically away from generic model development towards specialized, domain-specific execution, and that is precisely where the recent daily swings of this equity become interesting. When macro pressures, interest rates stay elevated, or federal spending bills get caught up in congressional gridlock, small-cap tech stocks tend to get hammered indiscriminately. However, companies with deep-rooted military and intelligence agency integrations tend to hold a unique shield against standard consumer-driven recessions. During the last earnings cycle, the company actually beat top-line revenue expectations by bringing in over $34 million for the quarter, yet the bottom-line net income remained in negative territory due to elevated research and development spending and costs associated with scaling their secure edge computing solutions. This creates a fascinating divergence. The business is successfully winning contracts and growing its industrial footprint, but the cost of executing those contracts prevents the immediate margin expansion that casual onlookers want to see when they click buy on their online investment applications. To truly understand why the stock is behaving this way, it helps to step back and look at what this enterprise actually does from a practical operational standpoint. Founded way back in 1988 and headquartered in Virginia, the company spent decades operating in the shadows of the United States defense apparatus, long before artificial intelligence became a dominant financial buzzword. Their business model revolves entirely around decision intelligence software, which is just a professional way of saying they take massive, incredibly messy datasets from satellites, supply chains, and secure military networks, clean it all up, and give operators a clear set of actionable choices. They're not trying to build consumer chatbots or artistic image generators. They are building the back-end analytics systems that help a logistics officer decide the safest route for a cargo fleet, or help border security track anomalies in biometric data. This heritage means their operational DNA is deeply bureaucratic, relying on complex government procurement processes that take months or even years to fully materialize into cash flow on a balance sheet. This legacy operational style is exactly why the financial profiles on classic Fidelity Investments dashboards or SoFi investing metrics look so unusual compared to standard commercial software businesses. When you look at classic Fidelity mutual funds or individual growth portfolios, they prefer clean, predictable, recurring revenue that scales with minimal human intervention. BigBear.ai does not offer that clean simplicity. A significant chunk of their revenue still comes from direct engineering services and hands-on system integration, meaning its expansion requires hiring highly specialized, cleared personnel. This hybrid model naturally limits how fast they can scale, acting as a structural drag on short-term valuation upside, while simultaneously building an incredibly deep competitive moat. A standard commercial competitor cannot simply copy their platform and bid on a Department of Defense contract because they lack the decades of security clearances, past performance evaluations, and institutional trust that this enterprise has spent over 30 years accumulating. Comment below how many shares of BigBear.ai you currently hold in your portfolio and whether you are buying this for the government defense contracts or the commercial logistics expansion. Looking toward the future, the primary catalyst for structural equity growth will be the successful transition of this technology from purely government applications into massive commercial logistics networks, exactly like the Panama Canal framework we are witnessing roll out now. If the company can prove that its predictive analytics solutions can visibly reduce shipping delays and optimize terminal operations for global trade hubs, the addressable market expands exponentially beyond the constraints of federal defense budgets. The risk, of course, is that international commercial sales cycles are notoriously fickle and highly dependent on global macroeconomic health. If global shipping volumes contract due to geopolitical tensions or trade disputes, commercial operators will quickly freeze their technology budgets, leaving the company heavily reliant on its baseline federal contracts to keep the lights on. This reality sets up a clear boundaries framework for the stock over the next 12 to 18 months, a baseline defense backlog that protects against total business failure, balanced against a highly speculative commercial pipeline that represents the actual engine for explosive equity growth. When managing an individual brokerage approach, whether you prefer the automated asset allocation of a SoFi robo-advisor, the low-cost simplicity of Robinhood investments, or the heavy-duty analytical tools found within the Fidelity trading platform, small-cap integrations require a high tolerance for structural volatility. The expectations surrounding the stock will likely continue to swing wildly between retail hype and institutional skepticism, causing sharp intraday movements that do not always align with the underlying corporate performance. For the long-term investor, the core strategy involves filtering out the noise of daily social media sentiment and tracking the literal hard data, the quarterly expansion of the contract backlog, the stabilization of operating expenses, and the conversion efficiency of international commercial pilots into long-term enterprise agreements. If the enterprise can successfully bridge the gap between high-level national security applications and real-world industrial supply chains, the current single-digit share price will look like a massive structural mispricing by the market. In closing, the central dynamic governing BigBear.ai remains a clear conflict between short-term retail narrative expectations and long-term institutional reality. The market frequently penalizes the stock for its lack of immediate, massive software margins, while completely ignoring the resilient, deeply entrenched nature of its federal revenue streams and its expanding footprint in critical global infrastructure like the Panama Dry Canal. By evaluating this equity not as a volatile retail meme stock, but as a specialized industrial analytics integration business, you gain a significantly more grounded perspective on its true risk-reward profile. Success here will not be defined by overnight social media trends, but by the slow, methodical execution of high-consequence data management across both military operations and global commerce networks. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Back. Don't forget to like, comment, and share this video to support the channel. Heart.